Good morning, everyone. Welcome to our Wednesday morning trading session. My name is Eric Senft. I'm going to be your host here this morning. All right. Hold on a second here while I get the screen share going on. Okay, for those of you new to our trading room this morning, welcome. What you're looking at here is the diversified trading system. And it's diversified because we're looking at the market from three different points of view. We have three different tools to try to take advantage of the market when different market conditions exist. Across the top here, we have the Hawk Scalper. Through the middle is the Falcon Swing Trader, and across the bottom is the Eagle Trend Trader. The charts I'm looking at here are the NASDAQ, and I've also got the E-mini and crude oil open on my other monitor, but I would be happy to open up any market that you're interested in. Just let me know. Regardless of the tool, the signals all develop the same way. So what we're looking for is we're looking for a warning dot, and we also get an audio alert with that warning dot. And then when the signal parameters are met, we get a triangle and a hash mark. So it's kind of it's a two-stage system. You get the warning dot that alerts you to the possibility that a trade may be forming. Then you get the triangle hash mark telling you that a trade is complete. In most cases, what we're going to look for is we're going to look for confluence. We're going to look for uniformity. In this case, we're looking for, well, here, let's start with this signal right here, the first micro-macro cross. We're looking for green bars, green trend lines, green filter. That would be a high probability signal. This one here that I was pointing to is also one of our high probability signals. This is the macro pullback signal. And it's identifiable because the micro line, that's this thin one, goes out of sync. But everything else stays in sync. So we've still got green bars, green filter, green macro trend line. That's this thick one. And of course, a green signal. So both these high probability scalp signals, and you can see that in both instances. Well, this one, the first micro-macro cross, I'm not sure it found its profit target right off. Oh, just kissed the profit target, and then we came back with a macro pullback. So you had a couple opportunities. Regardless, both look like they finally hit the profit objective. So it's only a minute or so, actually a couple minutes into the session now. So we'll give them a few minutes to get their bearings. Yesterday, a little bit of an odd day. Market opened with a huge opening gap. Let's take a look here at the Eagle. So prices leaving off yesterday down here around the 4,800 area, opening with a big gap around 48.45, and the market a little bit reluctant, but finally put it in a little bit of a rally, only to unwind again in the afternoon. So very simple day yesterday, even though we spent a lot of time waiting, at least on the Eagle. And so here we are. The market left off around the 48.25, 26 area, and that's pretty much where we opened up again this morning. With the Eagle Trend Trader, we have this band on here. This band gives us our directional bias. No, it's not an Ichimoku cloud. I know it looks like one, but it's not. when the band is stacked this way with this, what we call the soft edge above the hard edge, we're looking for buy signals. When the band reverses and it puts the soft edge below the hard edge, we're looking for sell signals. As a rule of thumb, when the market encounters the hard edge of the trading band, we usually see some sort of reaction. You can see what happened back here. The market drifts into the trading band, hits the hard edge. This is actually what we call a red bar buy signal on the Eagle. It's one of our high probability signals, and you can see why. We had some very nice follow through there. But what happens is the market's drifting, the momentum is actually shifting so that the bars are now painting red, and then it's almost like the market encounters the hard edge and the buyers get a wake-up call, because now all of a sudden we're printing a red bar with a green buy signal. That's a red bar buy. The opposite of that would be a green bar sell, and you can see the same thing is sort of happening here in reverse at the moment, where we're getting a green bar with a red warning dot. We don't have a complete signal just yet, but it does appear as though we might be trying to get one. Maybe. We'll see. So that's the Hawk Scalper, the Eagle Trend Trader, Falcon Swing Trader here in the middle. Here, before I get into the Falcon too much, these lines that you see here, this is the ultimate support and resistance suite. And this is what we refer to as a system add-on. In other words, it's a standalone indicator. You can put it on any chart you want. Does not need to be a DTS chart. No, they are not floor pivots. No, they are not Fibonacci retracements. They're actually much better. If they happen to coincide with one of those, it's really by coincidence and not design. This is an assortment of 21 support and resistance lines forecast for today's trading. The three lines that you see here through the middle, the gold line, which is the median line, the blue line above and blue line below, which are primary resistance and primary support, these kind of set the tone for the day. And you can see, again, the market relatively neutral through here because we're riding, riding the median line. And we're just kind of sitting there for now. The Falcon Swing Trader pays a lot of attention to this trend line that runs through here. When the trend line is red, we're looking for sell signals. When the trend line is green, we're looking for buy signals. In most instances, we're also looking for confluence. So that means we would like to have a green trend line, a green signal, and a green filter. So this would be what we call our trend change signal, which is essentially the first signal after the trend line changes color, the first in sync signal. That was followed a few bars later by what we call a late filter entry signal. This was pre-market. The late filter entry signal, pretty easy to identify. Everything stays in sync except the filter. Filter goes out of sync and must come back into sync. We printed a buy signal here and a nice little swing rally out of that. So at the moment, we're just kind of stuck. You can see the trend line trying to change color here. It's still not entirely clear which way the market is leaning this morning. But regardless, if we don't get a decent signal soon, I will demonstrate a signal for you so that you can see how these tools work. crude oil a little bit more aggressive, slightly. Here is crude oil now on the Hawk Scalper. And this little pattern through here is what we refer to as a 3-arrow consolidation. In some of the other markets, we're looking for 4 arrows, but in crude oil, 3 arrows will do because the market tends to move a little bit faster or a little bit sooner. Faster, not so much a word that's used for crude oil lately, but a nice, decent little 3-arrow consolidation pattern through here and a little bit of a scalp opportunity through there. Really good first micro-macro cross signal. First micro-macro cross signal, a very high probability signal. It's, well, as the name suggests, it occurs when the micro line crosses the macro line and we print a signal. Remember though, the signal has to be in sync, so we need green bars, green trend lines, green filter. This one just got in under the wire and great follow through there. A little bit of a macro pullback. Remember, everything stays in sync except the thin micro line changes color. So nice follow through on that one. And that was followed by a consolidation, or pardon me, in this case, 3-arrow. Because it's crude. And another scalp out of that. So some nice opportunities already on crude oil through the overnight. All right, well, we're still waiting. Here, one thing I'll show you on the Hawk Scalper, people ask, how can you tell when a market is getting choppy? Well, the Hawk Scalper, because it's a scalping tool, it tends to be a little bit more sensitive, and it will alert you to a market that's potentially becoming more choppy, perhaps before the other tools. And what you're looking for are these clusters of yellow bars. When we get these clusters of yellow bars, especially when they start printing on more or less the same price level, that tells you that we may be entering a period of congestion. Now, just because we print yellow bars doesn't mean the market's going to go sideways. The market needs to print yellow bars when it changes direction. However, let me go back here to a period that was a little choppier. When your chart starts to look like this, you know you're in a period of congestion. You're in a period of chop. And, you know, the best way to deal with a choppy market really is just to avoid it. Yes, you can still get some signals through here. You see we got a first micro-macro cross. We got another one here. We got a green bar sell. These are all Hawk signals. We would have taken a serious amount of heat on these, not to say we wouldn't have managed them correctly, but the momentum was not immediately apparent. So you'd have to sit on this trade for about, oh, looked like about 20 minutes or so before it finally hit its profit objective. And I do believe that was a trade that we sat on for a while before it finally hit its profit target. So, potential choppy market, not choppy yet, but we'll see if this drifts higher. You can see we're trying to produce a sell signal. The macro line, the thick one, not in sync yet. So this is not a confirmed signal. But if the market drifts a little higher here, gets back into yellow bars, then we may be entering a period of chop. All right, doesn't look like I'm going to get a signal just yet, so I'm going to take a moment and explain this fancy tool here on the right-hand side. This piece of software here, this is called the Trade Manager. And no word of a lie, it's probably the most important piece of trading software you can own because it does two things for you. It controls your risk and, well, conversely, it maximizes your profit as well. And it also gives you a way to manage your trade. So let's take a look at these two things individually. We'll start with the what we call the profit manager portion, namely all these stop strategies. What these look like is they look like this. The trade manager automatically will manage your trade according to one of these 16 different stop strategies, and they're all customizable. You can change the settings. So right now I've got the ATR stop on. Let's say I wanted to go to the chandelier stop. I simply click chandelier tab, accept it, and now I've changed my stop strategy. And like I said, you can customize these. You can make them more or less aggressive, or if you want it to be more conservative still. And what the trade manager will do, as I said, it will take your stop and it will roll it according to this stop strategy automatically. So let's say you had taken this first micro-macro cross signal back here and you chose to use the chandelier stop. Well, you could still be in this trade. Now, if you didn't want to be that conservative with it, you could have gone with something more aggressive, maybe like a parabolic stop, or even just the basic ATR. So you've got lots of options. So that's the profit manager portion of the trade manager. Then we also have this component down here. This is the risk manager component. There are two modes available with the trade manager. There's the risk percent mode and the manual mode. Manual mode, as the name suggests, is you just plug in how many contracts you want to trade and you set that amount up here, and it will always give you that number of contracts. So let's say I wanted to trade, 5 contracts. And so I set up my trade to enter. This is a first micro-macro cross signal, and let's say I'm going to put my stop down there. There's my trade. Now, I've currently set my targets at, I can preset as many as 3 targets, the last one being a runner. I'm currently all in, all out, and I've auto set my targets. So target 1, 100%, 10 ticks, but I can change that. Let's say I wanted to have, take half my profit on target and leave the other half as a runner. So you see it defaults to the runner position 50-50. So then my same trade would look something like this. So I've got 5 contracts, half off at target 1, and the other 3 would be a runner. And as you can notice, Trade Manager rounds down. And I can, I can do this however I want. Let's say I want to go in thirds. If I choose to preset a target, so now let's say I need another target down here, and we'll make that 20 ticks. I'm only doing this because we're not missing anything trade-wise. All right, so here you go. So 5 contracts, target 1, 2 contracts, target 2, another third off, another 2 contracts, and then the remainder on as a runner. All right. Now the other mode, the risk percent mode, this is ultra important because the risk percent mode will always cap your risk at a percentage of your trading capital. So what that means is you never ever overexpose yourself. If there's one thing I see traders doing wrong all the time, is that they risk more than they can afford. And I see there's a couple questions here, and I'm going to get to those in just a second, but just let me point this out really quick to you how this works. So what do most traders do? Well, most traders are scared to death of losing money, so they keep their stops ultra tight, right? But look what happens in the risk percent mode. This is 2% of my capital. Don't freak out if it seems like a lot of money, or if it doesn't seem like a lot of money. This is 2% of my trading capital. So Trade Manager says, okay, Eric, if you're going to set up a trade this way, you're going to risk 2% or $400, and you can put this trade on using 8 contracts. Oh, all right, sounds pretty good. Well, what's the problem with that? Well, the problem with that is sometimes the market wiggles around a little bit first before going up to your profit target, and you can get stopped out prematurely. So what should you do? Well, what if we leave our stops a little bit further back? What if we put them down here? Oh, look, the risk amount does not change. What if I put my stops way down here? Oh, okay, well, a little bit of a rounding thing going on. I can actually go another $130 lower, but the point is the risk amount does not change. What does change is your exposure, contract-wise. So here I'm trading 1 contract. Here I'm trading 3 contracts. And here I'm trading 7 or 8 contracts, but the risk amount never changes. What does change? Well, my profit potential changes. And the probability of my success changes. The probability that I'm going to hit my profit target before the market hits my stop loss at this point is probably about 50-50, right? 50% chance it'll go up and hit my target, 50% chance it'll come down, hit my stop loss. The probability that the market will hit my profit target before hitting my stop loss this way is probably better than 80%. Right? I've got a whole lot of room down here for the market to move against me, and yet I only require it to move a little ways to find my profit objective. This is a very high probability trade. And as it turns out, the market did give us a little heat before finally going up and hitting our profit target. All right, so there's just a really quick little overview of how those things work. A couple great questions here. Lee, great to see you, Lee. Haven't seen you for a while. Lee asks, is there a way to know which stop is best, or is there a way to optimize? Yes, there is, Lee, and there's actually a fantastic tool available called the Profit Finder. And what the Profit Finder is, it's a backtesting tool. And what that means is you can go through your chart. Essentially what you do is you turn off the arrows. So you go to your indicator window and you go to your tool, and here at the bottom you turn off your arrows. Actually, you know what? There's not much going on. I can demo this for you really, really quick. Profit Finder, where'd you go? There it is, Profit Finder. Okay, now the session settings and everything are going to be off, but remember, this is just a very quick demonstration. So the trading hours are not for my time zone. You see it's blocking out all this here. Come on. All right, this gives us a little more. So what you do now is you go through your chart, and using your chart markers, your arrow up or your arrow down for your buy and sell signals, you plot where you would have bought and sold. So here's a first micro macro cross lower, so we would have sold here. Here's another one, we would have sold here. Here's a 4-arrow consolidation, sold there. Okay, so and ideally what you do is you scroll through your chart like this, so you're not cheating. Right? So you're actually testing your system and saying, oh, okay, here's a green bar sell, we'll short here. So once you've gone through your chart, and this really doesn't take that long to do, and you can do like 5 or 10 or even 20 days if you like. Once you do that, you hit your Calc Performance button, and this will, oh, hold on a second here. Let's get all this stuff in the background. There we go. Okay, so you calculate your performance, and what it does is it gives you a quick rundown of your trade. So right now I've got a negative profit, so I've lost $30 on those trades. My max drawdown, my percentage profitable, number of winning trades, number of losing trades, and so on and so forth. You get just a whole lot of information here. Okay, why is that useful? Well, now you can go into your Profit Finder tool and you can start tweaking. So you can go to your Profit Finder and you can start making changes. So by that I mean, where are you? See, there's lots of things you can test here. Where's the stops? Okay, here we go. So trailing stop type. Currently, I don't have a trailing stop. You can choose from all these stops. Let's say we're going to test the ATR stop. Is entry a filter? In other words, is the ATR stop in sync with the trade or against the trade? Are you going to use that to determine whether the signal is valid and so on and so forth? And you can set your parameters right here for your ATR stop. And you are able to adjust the parameters for all the other stop strategies as well. So you have all those options to set down here. You can test break-even stops. See, here's a break-even stop. When should you take a break-even stop? And what I suggest is you make these changes one at a time. So we apply those changes, and now we do a retest, and okay, well, we're doing a little better. We've lost half as much money. And you can see how the signals unfolded here as well. So you can say, okay, well, this was my signal, this was my stop loss, and so on and so forth. So with a tool like the Profit Finder, you can actually optimize your market. Regardless of what market you're trading, you can optimize your stops, you can optimize break-even triggers, and as I said, it really doesn't take that long to do, because once you have it set up, you just go through here and you make changes one at a time. And you say, okay, well, that was a little better, so maybe what I need to do is I need to run break-even. So I'm going to go break-even at 10 ticks, and I'm going to save 2 ticks in profit, and see how that works. You go through this, calculate your performance. Okay, that didn't make much of a change, and you go through this optimizing your system. Fantastic tool. It allows you to do months worth of back testing within a matter of an hour or two. Right? So there's a great way to optimize your trading system. Oops, wrong tool. Oh, I should put the Day Ranger back on. doggone it. Sorry, folks. The Day Ranger is another one of these add-ons, meaning that it will work on any chart. It does not need to be a DTS chart. But what the Day Ranger does is it gives you the daily range. So today's range 95 ticks, yesterday's range 152, the 5-day average just under 156, 10-day average 170, and the 30-day average just under 180. Well, what does that tell me? Well, that tells me the market's contracting, it's getting tighter. And if today's range is anything like yesterday's range, well, we've only got about another 50 ticks to go before the market's going to flatline. Very useful for you Forex traders because it gives you a key to market momentum. You know, there's a theory that the market will only move so many ticks a day. And I personally subscribe to that theory. I think a market like crude oil, for instance, has a tendency to move about 100 ticks or $1,000 a day. And when that's done, well, that's done. They'll kind of wait till the next day. So good question, Lee. And of course you can optimize the old-fashioned way as well, just by using it. What I tend to do though, for optimizing stops and so on, I'll throw a stop on and I'll look at a signal like the macro pullback signal, and if the stop seems to be following the signal pretty well, I'll go with that stop to start. I can always adjust it as the trade goes on. So let's say I was in this macro pullback signal and I'm looking at all this open profit and I'm thinking, oh dear, you know, that's like at least $100 from where the market is to my stop loss. I want to go with something more aggressive. Maybe I'll go with the parabolics. I can change that. I can change that on the fly. Good question. Moses is asking, does the trade manager come with any of the birds? The trade manager is another add-on. So you can certainly package it with the DTS system. It's also a separate standalone trading tool. So you can use it independent as well. Great question here from Frank. Frank asks, should we use these stops to incite a trade since it looks like they track the trend well? You know what, Frank? There's a lot of these stop strategies actually got their start as trading systems. For instance, parabolics. There is a trading system with parabolics where you're always in the market, essentially. So when the parabolic is violated this way, you buy, and when the parabolic is violated below the low, you sell. And you can see it's not a bad system. Sometimes you got to be a little bit aggressive with your stops. For instance, if we sold here, and we would have got stopped there on the reversal, so that would have been a small loss, but the next one a nice winner. Then we would have sold here again, been stopped out here for a small profit. Parabolics work great. Before you get too excited, parabolics work great when the market has some momentum, but you kind of get chewed up a little bit when it keeps flip-flopping back and forth like this. Say we would have shorted here, we would have been stopped out there. That's a little bit more significant loss. Would have been shorted here, would have been stopped out here for another loss. But yeah, parabolics started that way. Super trend, another one that started as an entry strategy, and like the parabolics, it's an always-in strategy. So you're either long or short. The market breaches to the upside, you buy. The market breaches to the short side, you sell. To answer your question, yes, you can use the stop strategy as a filter. In fact, you'll notice here on a lot of the tools, you actually have the ability to enable a stop strategy as a filter. So in this case, the chandelier strategy on the hawk, you can use it to filter signals. Okay, interesting comment here from Lee. Lee's, I think in regards to Lee's previous question, is there a way to know which stop is best optimized so it gets hit the least amount of times? All right, here is something that, and I'm just looking to make sure we're not missing a signal. We're not really missing a signal just yet. If we don't get a decent signal soon, I will take a signal so you can see how all this works. But here is a what I think was a real eye-opener for me, and I know people as well. Okay, so Lee's question is, where do we put our stops so that we don't get hit? Well, the best stop is always a fundamental swing point. Why? Well, take a look at what happens here. The market makes a rather aggressive move lower, right? It's been falling for part of 3 hours, 2 hours, 3 hours. And then it finally stops. Well, what made it stop? Well, what made it stop is that the buyers owned the sellers. There were more buyers than there were sellers. Therefore, this is if you're going to be a buyer, this is a good place to put your stop. Now, a lot of people look at that and they say, oh, Eric, I can't afford that because, look, I'm going to put my entry here and my stop loss is down there. That's a lot of money. Well, it is, but you also have to consider the probability of the trade, right? There's no point in keeping your stop small if you're going to get hit all the time. So that's why the trade manager is such an important tool. You keep your stop, it helps you keep your stop away without having to worry about risking too much money. You see, what most people do is they say, oh, well, I'm a small trader. I'm going to be really careful. I'm only going to trade 3 contracts. And so what happens is you keep your stops ultra tight, thinking you're doing well by only risking $165 on this trade, because you could never imagine putting a stop down here and saying, oh, no way, $700, forget that. But did you see what the trade manager did? See, now I'm in manual mode with three contracts. If I go to risk mode, the trade manager allows me to put my stop wherever I want, and I never risk too much money. So I can structure my trade reasonably. I can look at the trade. Here, let's take a look at this one here. Okay, because here's the first micro-macro cross signal. It's a little unnerving because you're looking at this and you're saying, well, where am I going to cover this trade? Am I going to put it right up here? Now, one thing I will mention is that Trade Manager is very good at picking up market momentum. Or pardon me, the DTS system is very good at picking up market momentum. A lot of times you'll get a signal and the market will just go. But not always. Sometimes the market is still a little conflicted. And you can see we're at some pretty substantial lows. So where should we place our stops? Well, at the very least, we should probably place our stops above the crest and the macro line. So what the Trade Manager allows me to do is I never risk more than I can afford, but I'm always maximizing my winners. So in this case, I'll be able to take 2 contracts. Compare that with the onesie-twosie trader or the onesie trader who would only earn $50 on this trade. I have options here, right? I can split this up. I can maybe take half on target and leave the other position in as a runner. So I bank profit, hooray for me, roll my stops to break even, and then manage to catch a little bit of a runner. So your best stop is always going to be below or above a fundamental swing point, and the trade manager allows you to place your stops there without risking too much money. Now, we addressed this the other day in the trading room when we were looking for places to place our stop, and I said, if you're ever in a doubt, a reasonably safe place to put a stop is 2 swings back. So here's a macro pullback signal. We're looking at it. All right, macro pullback. Remember the macro pullback, everything stays in sync except the thin line, the micro line, it goes out of sync. So here's swing 1, here's swing 2. That's a pretty safe stop. The chances that the market will hit this low before it hits my profit objective are pretty remote. And there you go. You end up putting a little bit more money in the bank. You see, your stop loss, people hesitate putting a deeper stop loss because they think, oh, it's bigger risk. But it's not. It's the same risk. Right? You're risking the same. If I put my stop here, it's still about $400. What changes is the number of contracts I trade. What changes is the profit side of the equation. But what people forget is that your stop loss, and it's really a bad word for it, is not a loss if it doesn't get hit. Right? So why should you put it in harm's way? Why should you try to pinch a trade so tight that the trade has no chance of working out? Well, it's a rhetorical question. You shouldn't. You should keep your stops far enough away that you don't get hit. All right, I know I get a little bit passionate about that, but it's just I see so many people strangling their trades, trying to limit their losses. I'll tell you a quick little story because you can see, as I mentioned, we're printing a lot of yellow bars here on the same price level. The market's in chop right now, so we don't really have a decent trade to take. I guess it's going on about 3 years now that Derek became a DTS owner, and he was always a onesie-twosie kind of trader. And he'd been trading for a while now. He made a little money, he lost a little money, but he never really got any traction. So he'd been trading all these years, and he still had pretty much the same money that he started with, which is obviously not the point of the exercise. So Derek got the DTS system, he got the trade manager, and then all of a sudden he saw the importance of position sizing. That's technically the term for what we're doing here. It's position sizing. So whereas Derek always used to just throw in, one contract, and he'd run his trade like this, and he would win sometimes and he would lose sometimes. Or what he would do is the traditional. Oh, by the way, you can also click for your profit targets. So he would say, okay, I'm going to put my stop loss down here, so I need to get twice as much or 3 times as much profit as my stop loss. Do you recognize what I just did wrong there? I'm basing my profit target on my stop loss. Okay, intuitively that makes sense, right? If it wins, I earn 3 times as much. If I lose, I've lost less. But you're totally ignoring the probability of the trade. You're totally ignoring the probability that the market will actually get up here before hitting your profit target. And if you're like most people, you end up getting into this trade only to get stopped out. And at the end of the month, you look at your statement and you see small loss, small loss, small loss. And somewhere through there, a light bulb should go on and say, man, if I had only taken small profits instead of all those small losses, instead of being down $1,000 this month or whatever, I could be up $1,000 or whatever. Right? Of course. So Derek got the DTS system, he got the trade manager, he started controlling his risk, and he started structuring his trades correctly so that when he lost, he did not lose more than he could afford. And when he won, he would always maximize his earning potential. Well, within about a year, I guess it was just over a year, Derek's trading was outpacing his job, so he quit his job and he started trading full time. A couple of years later, Derek started trading other people's money. And that's what he does now, is he trades for other people. And it's, honestly, folks, it's based on the DTS system and the trade manager. And, you know, I say it all the time, you need three things to be a successful trader. You need a good signal, you need a way to manage the trade, and you need correct money management. And yet, all people are interested in is the signal. Show me a way to optimize my Bollinger Bands. Give me the best settings for my stochastics. What settings should I use for RSI? Right? That's all anybody talks about. And some of the more astute traders will actually start to pay attention to how they should manage their trades. But very few retail traders, and by retail traders I mean people like you and I, ever give any consideration to how they should manage their risk. And yet, the risk is the risk is the only thing you have control over. You don't have control over the profit. You have no idea how far the market's going to go. Yeah, we all have our best guesses, but if anybody tells you otherwise, they're lying. Nobody, and I do mean nobody, knows where the market will go next. The market is very balanced right now. There's a 50-50 chance it will go up. There's a 50-50 chance it will go down. If it breaks up, yeah, I can make a guess, right? I can look at this and I can say, all right, well, the market's about, the channel's about yay tall, so there's a very good chance it's going to move at least one width of the channel, so we could look for a profit somewhere around 48.45. And likewise, if it breaks down through the bottom, maybe 48.14, right? Or I can use my support and resistance suite. And I can say, all right, if the market breaks up, I know it's going to move two zones, so probably 48.46. Oh, pretty close to 48.45, isn't it? If it breaks primary support, it's likely going to move two zones. Well, the first zone is 48.14 3/4, again 48.15. It still amazes me how these lines can predict where the market is likely to stall. That's exactly the price we figured off of the range that it just did, the range calculation. Or if it violates that range, it's likely to go to 48.07. Right? So I can use those as profit objectives as well. But nobody knows where the market's going to go. So what should you do? Well, as a trader, there's only one thing you can do, and that's protect your risk. That's the only thing you have control over. So when you get a signal, and we're potentially working a first micro-macro cross signal here, don't risk more than you can afford. Or if the market's moving sideways like this and the trade's looking a little iffy, well, dial down the risk amount. Maybe I'll only risk 1% on this trade. And we'll set it up. And here's the beauty of this as well. What if I want to put my stop way down here? Oh, trade manager says, sorry, Eric, you can't afford it. So not only does the trade manager protect me by not allowing me to risk more than I can afford, it also optimizes my earnings. So when I have a winning trade, I've maximized my earnings. And if I try to take a trade I can't afford, it won't allow me to do it. All right, not the best looking signal, but we've been waiting here long enough. So I'm going to throw an order in here so you can see how all this works if we get a fill here. We've got the warning dot, the macro line, everything is in sync. If the market trades higher, we're going to print a first micro-macro cross signal. So there we go. We've got the triangle, we've got the hash mark, we've engaged the order. My trade is currently live. And we can throw a stop below the last swing low, maybe a couple, 3 ticks back. Now you can see I can also preview all my stops. So I've got a swing low. I'm going to enable this and accept it. So now the trade manager will automatically manage my trade according to the stop strategy that I've selected. You can see I've also got a break-even trigger in play. So if the market rallies and hits the break-even, it will roll my stop automatically from down here to break-even +1. And I can even run a negative break-even if I want, or I can protect more profit. Let's say I want to go break-even +3 ticks. A good question, and you guys have some great questions here, and thank you for your patience as I get to them, guys and girls. Frank's asking, should we leave all contracts as runners for larger profit, considering that we are risking 2%? Well, you know, that's a debate. The runners are great when they hit. Problem is, the market really only rallies about 25% of the time. I think, and this is my own personal opinion, I think that the less money you have to trade with, the better off you will be going all in, all out on target. Even if the market rallies past you. I'm not going to play with this chart. Let's go with this one here. So here's our trend change signal. Here's our late filter entry signal. Let's say we set up the trade to look something like this. We hit our profit target, and okay, we didn't go too much higher. Bad example. let me find another one. Here we go. Here, this is a good example. Okay, so here's a trend change signal. Trend line changes color. It's essentially the first signal where everything is in sync. But, you know, there's been a strong uptrend, so I don't know if the market's going to reverse or possibly, you know, bring me in and trail or head back through the highs. Trade manager says, okay, Eric, you can do this trade. You can trade 2 contracts. You'll make $200. So the market brings me in, and boom, I hit my $200, and then the market falls off without me, right? So I'm thinking, well, darn it, if I had had a runner in, I probably could have earned a little bit extra. Well, yes, I could have. Let's see how that works out, though. So let's say I do a 50-50 trade. All right, so right now my stops would be at break even. And after this little swing, I'm starting to get a lot of open profit. Let's say I go to a parabolic stop. And it looks like, I don't know if they tagged me here or not. We'll say not, just to Okay, so we would have been tagged down here. So we banked $100 on the initial contract, and we probably could have made another $200 on this one. So this is potentially a $300 trade instead of a $200 trade. But for every time that you'll hit one of those with a runner, you're going to encounter at least two of these, where you get the trade, you put the trade on, two contracts, you bank $100, you have your stop at break even, and you get hit at, we're going to say you get hit at break even here. So in this case, the other case, you didn't make an extra 100 by not using the runner. In this case, you didn't make an extra 100 because you did use the runner. Does that make sense? I know it's a little convoluted, but it's the whole bird in the hand type scenario. So when you're in a trade, and if you're trading a small account, even though occasionally you'll have the market run away from you, and you'll think, oh darn it, I should have had a runner in play, you'll almost always do better going all in, all out on target. And speaking of which, I meant to delete the profit objective here so that we could try to roll the stops a little bit so I could show you how Trade Manager rolled the stops. Darn it. Darn it, we hit our profit target. All right, well, there's the first micro-macro cross, right? It's a high probability signal. It should hit its profit target. Frank's asking. Frank's loaded with good questions here. Frank's asking, should we use the built-in stop types for a better stop at entry? This way the stop is not too far or close. You can. There's nothing wrong with, so I think what Frank is asking is, okay, if I'm using the, let's say an ATR stop, and here's my signal, can I use the ATR stop to start my trade? Yes. Yes, you can. Remember, though, if you're using your risk percent mode, there's no such thing as having your stop too far away, because your risk does not change. I can place my stop way, way, way down here. I can place my stop way down here. The risk does not change. What does change? Well, the probability that the trade works out will change, right? Versus putting my stop right here. Or heaven forbid, if you were trying to get a 2-to-1 or 3-to-1 risk-reward ratio on this trade, you'd place your stop right there. But there's no such thing as having your stop too far away when you're using the Trade Manager. The Trade Manager always manages your stops correctly. But yes, to answer your question, by all means, you can. And like I say, the DTS system is exceptional at picking up market momentum. That's why it's really difficult for me sometimes to find a decent example of a market thrashing about a little bit before going to its profit objective. Because you'll get a trade like this, you'll risk your $400 or 2% of your trading capital, and, you know, boom, boom, boom. A couple minutes later, you're up a couple $100. Now, what a lot of people need to remember too is that a lot of people have a production line mentality when it comes to trading. They're going to look at these tools and they're going to say, oh, wow, you know, I need to have 10 trading signals a day or 20 trading signals a day. No, you don't. You do not need to have 20 trading signals in a day. You need to have 2, maybe 3, perhaps 4 at the outside, and you need to correctly capitalize those signals. So if you're looking at a trade like this, and you hit your profit target, if you do that 2 or 3 times a day, that's $400, $500, $600 a day. If you can do that every trading day, we're only looking at finding 2 quality signals in a day and maximizing our earnings on it. You'll easily, there's 20 trading days in a month. Let's say you make, for easy math, $500 a day. That's $10,000 in a month. It's not going to take very long to build up your account to a point where you can earn more money, capitalize even greater. You don't make more money by taking more signals. You earn more money by correctly capitalizing on your trades. And admittedly, this is not something that you can jump into, jump into the deep end right out of the get-go. You have to work your way into it. People, you see me do this all the time in the trade room. Okay, we'll get a first micro-macro cross signal. The market still might be kind of sideways. I'm taking the signal because I know it's a high probability signal, but I'm going to risk it down here or maybe even down here. Why? Because I want to put the probabilities in my favor. I don't care that it's only $100 and I could have earned 200 or 150, or if I put my stops ultra tight, $400. I don't care about that. I want to almost guarantee my earning. Whether it be 50, 100, 200, I want to almost guarantee that that's as good as money in the bank. Well, I do that by finding a high probability signal, which this is. I do that by not stopping my trade, by keeping my stops far enough away. And even if this trade had turned here, let's say it didn't hit the profit target and it started to turn against me a little bit, I still have an opportunity to adjust my trade somewhere through here, probably as the market gets closer to the trend line. There's going to be a little bit of a bounce, and I can take my stop now from down here and I can roll it up. So whereas I initially had 350 at risk, now I may only have, say, 200. So even if the market turns on its heels right here and stops me out, I haven't lost 2%, I've only lost 1% of my trading capital. And with a $20,000 account, a $200 hit is not going to hurt. It's not going to devastate my account to the point where I can't trade anymore. And yet that's what most people end up doing, is they end up risking far more than they can afford. And then in a couple, 6 months time, they look at their statement and they wonder where all the money went. And they say, trading, it's rigged. Nobody can make money trading. No, it's not the market. It's, how you always joke about a breakup. It's not me, it's you. Well, I got a newsflash for you. It's you. Elmer asks, is the Profit Finder an indicator warehouse tool? Yes, it is. You can find it at the indicatorwarehouse.com website. Frank's asking, does a trade manager sync with a real account? Yes, absolutely, Frank. Oh, sorry guys, I missed the crude oil inventory. But you know what? We may still be able to get on it. So the inventory report came out right about here, a little bit of an uptick. What I'm going to do is I'm going to use my OCO order. Now that I know the top end of the market, I'm going to buy, set an order to buy up there, and well, I guess we do have some support here. Why don't I short down here? Now these orders are live once you put them on your chart, so you don't want to put them too close. And what I'll do is I'll enable a stop strategy, perhaps the parabolics. There we go. So all I've done here is We've allowed the crude inventory report to hit the floor, and you can see there was a little bit of an uptick. And now that we know what the current ranges are for the market, we'll bracket the high and the low, and we'll let the market bring us in. Dan, good question. Dan asks, when should you use 10 ticks for profit versus 20 ticks? This tool up here that I have on the Hawk, this is called the Day Ranger, and I pointed this out to you before. The Day Ranger is a great little tool for helping you identify market ranges. So let's say the Day Ranger said we had a 200 tick range. It looked like, you know, the 30-day average was, say, well, here, we'll go with these numbers. Okay, so the numbers are congesting a little bit. We're going from about 180 down to 155, 150. It looks like the market's contracting. So let's say you were looking at that and you said, all right, I think I'm going to shoot for 20% of the day's range as a profit objective. So if we're going to take 150 ticks as our range, 20% would be 30 ticks. And we're going to do that on 2 trades. We're going to try to take 2 trades through the day. So that means each trade would have a 15-tick profit target. To shoot for 3 trades on the day, I would go with a 10-tick target. So you can do it that way. Of course, if the market seems to be expanding, if we go from this Day Ranger, there's going to be times you're going to see the 5-day average. This is inverted. The 30-day average will be 150. The 5-day average will be 200. That shows you the market, it's getting more volatile. The ranges are getting bigger. Therefore, you know, if I wanted, say, 20% of a 200-tick range, I would have a 40-tick target. In which case, if I'm going to take 2 trades, I would have 20 ticks on each of those. All right, so we're waiting for crude oil to do something here. Moses asks, what's the difference between ATR and Trade Manager? Well, the ATR stands for Average True Range, and it's only one of the 16 stop strategies. The Trade Manager is this whole tool that you see here in the margin. It does the stop strategies, it has the risk component built in. It allows you to preset profit targets. We can also just hit the buy and sell market buttons. Andrew is asking, Eric, is there any advantage of the Falcon over the Raptor or vice versa? Okay, the Raptor, the Raptor we don't have on the screen here this morning. We just have the Hawk, the Falcon, and the Eagle. The Raptor is kind of a hybrid type trading system. It incorporates elements of the other 3 birds all into one. The advantage with the DTS system is that you've got specialized tools. You know, using the hybrid scenario, and this is just a rough analogy, but, you know, a Prius is not a Corvette, and neither is a Prius a F-250 pickup truck. Does that mean the Prius will not get you from A to B? Well, sure it will, but it won't do it as fast as a Corvette can do it. Does that mean you can't move your bookcase in the back of a Prius? Well, depends on the size of the bookcase, but yes, you can move your furniture from your apartment in your Prius, but not as efficiently as you can do it in the back of your Ford pickup. So the DTS tools are all specialized. But of course, you know, you can, Adam would be the one to actually ask. And if anybody has questions about that, I'm going to give you Adam's email address, adam@indicatorwarehouse.com. If you have any questions about the systems, or if you're interested and you're interested in bundling a few tools, you know, things like the support and resistance suite, the trade manager, the DTS tools, perhaps the day ranger, or whatever, the profit finder, talk to Adam, because very often he can give you a kind of a package deal. He's the guy to talk to about that. Stephen is asking, can you show a link showing the profit loss in the trading room? Well, I can show you the link for the previous trade rooms, and what we're doing right now is Adam's actually having me track the trade results via TraderView, which means you can't cheat. That's the long story short. Hold on a second here. Let's see if I can't find it. All right, well, this is a link for one of the past, what we called the profit run. And there's some of the results. Now, the profit run was a period of time when the DTS system first came out, where for 2 months I traded the DTS system, and honestly, the point of the exercise was to try to post a big number. And fortunately, things worked out, and I was able to show a profit at the end of it. And we've done 3 profit runs so far. But yes, we are recording the daily trading room trades now via TraderView, and you can view the results at the TraderView website. There's only a week's worth of stuff there, though. All right, so you can see now we've broke through the top end of this trading range. Notice Trade Manager automatically gave me a stop via my stop strategy that I've selected. I've got a break-even trigger in play. Now that the order is live, however, I can adjust these things. Let's say I wanted to put my break-even a little closer or a little further away. When you're using the OCO order, however, you don't get a profit target. That's one thing about the OCO function. OCO stands for one cancels other, by the way. But I can manually set a profit target. Let's say I'm going to look for the market to move 2 zones. So here it would be zone number 1, 52.10. Zone number 2 would be 52.40. And where did we start the day? 51.40. Yeah, so that would be our 100 ticks, $1,000. That would pretty much be the range for crude oil today. Frank's asking, would you use a percentage of the day range as a target? Yes, you can do that also. Referring back now to the Day Ranger tool. And that too is one of these system add-ons, a standalone type tool? Yeah, definitely. You can use a percentage of the daily range as a target. Just out of curiosity, Stephen, do you pronounce your last name Weiss or Weiss? My cousin is Marvin Weiss. He likes to pronounce his Weiss. And I know it's impossible for you to type it, type the pronunciation. You can tell me number one or number two. Weiss would be number one, Weiss would be number two. All right, so by the way, folks, that's an alternate way to trade the crude inventory. Usually what we do when we go into crude inventory, if I roll this back a little bit, is we take a look at how the market is prior to the inventory release, and hopefully it's channeling. And then we can bracket to take the trade either higher or lower. If you're unclear, or if the bracket seems a little bit too tight, because hey, let's face it, crude can be a pretty volatile market. The alternate strategy is to allow the market to release the report and then see what kind of range it makes and then bracket that range. That's kind of where we're at right now. All right, let's put that on the shelf for the moment. Sometimes, and I don't know if you've noticed this or not, sometimes the greatest challenge you'll have as a trader is keeping your stops out of the way so that you can make money. No problem, Lee. We'll see you later. Market's very, very quiet. I wonder if it's because the presidential debate tonight. I don't know why that would have influence on the market. Well, I know it has an influence on the market, but it's a debate. It's not really market news. Shoot, if the debate's going to wind up the market like this, imagine what's going to happen when we actually get to election day. Oh, I see. There's an FOMC report out this afternoon. That's going to put a little crimp in things. That's not a biggie, though. And what's on the books for tomorrow? Oh, unemployment. Okay. Well, something's got the market pacing. A slight bullish bias. So let's see here. I don't think we got a trend signal yet. This tool you see here in the top left, this is, I forgot to mention this add-on before, this is the Trade Forecaster. Trade Forecaster, again, a standalone type indicator. It's telling us the current market environment and what the next one is likely to be, and you can see that right now we are in full-on scalp mode for nearly an hour, after which we should be moving into trend mode. Well, that explains a lot. Here's the eagle trying to produce a trend change signal. So it's I guess our first signal in sync with the band was actually back here. We do have a follow-up signal now. It's a little bit odd because we haven't seen a really good retest of the lows. Let's go here to the Falcon. And a nice little trend change signal right here, kind of working that, working a late filter entry signal right here. See, I bet you guys can pick these out already. Late filter entry, remember, trend line does not change. Filter goes out of sync, comes back into sync. There's a trend change or late filter entry signal. And here's the trend change signal. This was also an early trend change signal if you were really aggressive on it. I tend to wait for the more conservative one. But hey, that's me. So it looks like we could have found our profit target. And we would now have a runner in play because we're doing a 50-50 split on the trade. So we're going to have our stops at break even and try to run that one out a little bit higher. That explains why we've been getting most of our signals here on the Hawk Scalper this morning. Well, most of our signals. We've had two solid signals. The first micro-macro cross signal right here and the macro pullback signal, both of which finding their profit targets. Now, I probably would not have framed it that way. If I was going with two swings back, there's swing one, there's swing two. The crest in the macro line looks pretty good to me. So we potentially, there was a $150 profit there, and swing one, swing two, $150 profit there. So even on such a sideways kind of day, it looks as though we could have comfortably banked about 300 in profit. Our crude oil trade progressing nicely. Now, we're so close to our break even. I'm going to force the trade to break even now. There we go. So even if it turns, I've got break even plus one tick. So that'll be enough to pay the broker. Got to look after the broker. Yes, great comment here from Bo. Bo asks, do you trade natural gas? I found it to be trending but bizarre asset. That is probably the best description I've heard of natural gas. Trending but bizarre asset and then able to make good entry timing. All right, let's take a look here at natural gas. We'll put that away. And we'll load up natural gas. I do believe November is still the current month for that. Tomorrow, of course, crude inventory or natural gas inventory. Okay, before we get too far along here, the default settings for the DTS system will work for 99% of the markets you're interested in trading. Every once in a while, however, you're going to look at a chart like this, and these vertical white lines, these are the daybreak lines. If you get one or two like that, it may just mean that the market's been a little bit quiet. But if your whole chart tends to look that way, you may actually need to adjust the brick size. So I'm going to dial down the brick size a little bit on this one. And, you know, not to worry. If you ever have difficulty with that, you can just write us and we can help you out. But don't be surprised when we tell you the default brick sizes work for almost all the markets. So all I'm looking for now is, you know, just because I have a quiet day, that's not the end of the world, but I just want to make sure that most of the days I'm producing at least a few signals and we get a reasonable amount of follow through. So it looks like a 10 tick brick might be adequate. Let's see here on the other charts. Yeah, that's about as tight as I would care to make it. Bear with me a second here while I put natural gas. We do have an alternate setting, and not to bore you with the details, but because some of the markets, you open them up and your chart looks like that, we do have an alternate setting. The most popular market that requires the alternate setting is the E. And the alternate setting is a 4-tick hawk, a 4-tick falcon, and a 6-tick eagle. So let me bring over now natural gas with the alternate setting. All right. So let's take a look at how some of these signals unfolded. Natural gas starts trading around 6 a.m. our time. First micro-macro cross signal right here, which currently giving you a little bit of heat if you didn't take profit on target. We're into yellow bars, which again suggests a sideways market. Looks like the overnight was very active. The European Open, right around here, a macro pullback signal. Great decline out of that. Nice first micro-macro cross signal right here. These are all our high probability signals that we focus on, by the way. So first micro-macro cross signal and a 4-arrow consolidation. Good follow through on that. First micro-macro cross. That might be the same macro pullback I was just looking at. Nice macro pullback here. This macro pullback, of course, got spoiled by the yellow bar. We don't trade the yellow bars, and you can see why. There wasn't enough follow through. So it's looking like the hawk caught some nice natural gas signals there on the alternate setting. Let's take a look now at the falcon. And we got a trend change signal. It printed a little bit late. This again through the overnight, but it doesn't matter. Still had some decent follow through. Came back with another trend change signal right here. Looks like that had some good follow through. Trend change signal to the upside just before the market open. Ooh, there you go. Okay, here you go, folks. This is something that you're never going to see another trading room moderator tell you. This was a losing trade. So the market did not hit its high probability target. In fact, it brought us in, turned on its heels, didn't even give us a second chance to adjust the trade, and then stopped us out. If I put my stop right there, that is. So even though these are high probability signals, unfortunately, they're not 100%. And I'm sure I don't need to tell you that no signal is 100%. But look at what happened. Even though we took a hit on the trade, we did not lose more than we can afford. Again, I cannot overemphasize how important that is. Oh, darn it, Eric. And you can see how important it is not to place your stop too tight. Doggone it. So here's the signal. Had I placed my stop below the swing low, which I told you is the most fundamentally sound part, our stop would not have been hit. And I would have actually had a chance to adjust the stop a little bit as this trade progressed. Darn it. Should take my own advice. All right, so it looks like there were a couple Falcon signals, and we're currently working this from the open. This buy signal, I don't believe we have hit its profit objective just yet. Oops. Let's try that again. No, just came up short of its profit target, and we're kind of holding out for that. So there's natural gas on the Falcon, and let's take a look at natural gas on the Eagle. Great green bar sell yesterday morning, and the market's just been tumbling ever since. If you're in a position to hold overnight, my goodness, that's a huge move. So the green bar sell, remember how I told you when we encounter the hard edge, we expect a reaction. And we got the green bar with the sell signal. That is a high probability signal. And just for kicks, let's see how far this one went. So there's the green bar sell. Place our stop there, and it didn't stop us out right down here. That's almost a $1,600 move. $800 per contract. That's substantial. Nice move. So it looks like the Eagle also producing some decent signals. Not so much this morning. We're still kind of sideways. The band technically still bearish. In fact, you could see perhaps a green bar sell right here. So a little bit of conflicting signals between the tools. The Hawk, very neutral, with a lot of yellow bars going through there. The Falcon was trying to get bullish, but now the trend line also turning a little bit bearish. If your stops were down here, I would probably bring them up, effectively reducing the risk considerably. So even if we place them below that support line, our entry is right there. We had started with 300 at risk. Looks like we got maybe 100, 125, give or take a few dollars at risk there. Yeah, I guess technically it's $110 from the original $300 risk amount. And the Eagle now looking sorry, just getting my chart put away. The Eagle now looking potentially bearish with this green bar sell. So we got the green bar, we got the sell signal. We've already got the reaction. You could set up your trade to look something like that. Or just go with the profit objective. So there's swing one. I wonder if that would be swing two. Technically swing two's up there, but maybe we'll split the difference. Oop. See what I mean? Trade managers reminding me I can't risk that much. All right, so we'll go above that swing. There we go. So there's a potential natural gas trade if we're getting a retest here of the low. Tom asks, can you buy one of the three DTS charts, and would that be better than the Raptor system? Well, you got to remember the reason we have the three tools, and that's because the market conditions change. If you've been trading for any time at all, no doubt you've experienced a time when your signal system works just great. Right? I don't care whether you're using a RSI crossover or a moving average cross or a Bollinger Band breakout or whatever. There's going to be times that it works just fantastic. And then later that week, you can't get a winning trade to save your life. So what happened? Well, your signal obviously didn't change, did it? No, you're using the same signal. So what changed? The underlying market condition changed. But you're still using the same tool to trade a different market. It's like my grandfather used to say, if the only tool you have is a hammer, then every problem tends to look like a nail. Well, here with the DTS system, you've got three different hammers. You've got a hammer for when the market environment is like today, We're not getting any trend today. We're getting nothing but scalp today. Right? So that's why we're getting all these scalp signals. If you had the, and it's still trying to load here, if we just had a trend tool, let's take a look here at the Eagle Trend Trader. If we just had a trend tool to trade with, well, I guess we did get a, is this the NQ? Yeah. I guess we did get a little bit of a signal through here, but there's going to be times that you're not going to get a trend signal because the market just isn't trending. But that doesn't mean you still can't make money. Let me go back here a couple of days. Here, we got a day where there's no real discernible trend, but there are still opportunities for a swing or a scalp. Frank's asking, does the trade manager take into account open trades and other charts to calculate the overall risk when taking a new trade? Yes. It looks at what your current balance is in your account and determines your risk exposure accordingly. Of course, it doesn't take into account open profit or open loss because it's not a profit or a loss until the trade closes out. Excuse me. Speaking of open profit or open loss, let's go here to the crude oil trade. So parabolic still holding in, where I suppose I can delete my break-even objective. And we may have to nurse this trade a little bit higher, but we've got nearly $200 in open profit, so don't be shy about grabbing that. And we're going to finish the session here with Tom's question, because Tom asked a great question. He says, if you get multiple signals, is there a way to cherry pick them? And there is. Hold on. Where did I put it? Okay, so Tom asked, when you get multiple signals, is it better to stay out, or is there a way to cherry pick the best ones to take? We have already done the heavy lifting for you. So each of our tools has what we call the high probability signals. These are the signals that we're going to be looking for. These are the high probability trades, ones that you can take with a great deal of confidence. This is the Hawk Scalper. Two of these signals you've already seen, the first micro-macro cross and the macro pullback, both very high probability signals. 4-arrow consolidation, another high probability signal. The post-consolidation signal. Coincidentally, this one also happens to be a macro pullback. And then we have a red bar buy or a green bar sell at the end of the trend. Those are the high probability signals for the Hawk. The Falcon signals, these are the high probability signals that we're going to be focusing on. So we're going to look for the trend change signal. Unfortunately, this signal printed a little bit late. Normally it prints a little bit closer. You can see this bar right here was trying to become a trend change signal, but the market drifted a little bit. Even so, even with the later entry, you can see there was still a lot of room to swing through here. The late filter entry signal, another high probability signal. And then our basic trend line touch signal, when the market retreats back into the trend line and then bounces out, produces a signal. These are the high probability signals that we're looking for on the Falcon. And then we'll also have high probability signals here on the Eagle. I'm sorry I haven't labeled the chart just yet, but just very quickly, we've looked at some of these. The hard edge bounce, namely the red bar buy, or the green bar sell, right? Whenever the market encounters the hard edge. We have the basic trend change signal, so when the band changes direction, the market drifts into the band, comes out, produces a signal. And then we have the counter trend signal known as the rule of three, when the market prints three signals against the hard edge. So we have a bullish band, but we've printed three sell signals. That's the rule of three signal that alerts us to the possibility of a move, a counter trend move. So yes, Tom, there is definitely a way to cherry pick the trades, to cherry pick the best ones. We definitely not looking to take every single signal. You know, there's like this signal up here. There's no reason whatsoever to take that signal. All right, so I hope that answers everybody's questions. If not, please type away. Otherwise, you can always reach me or Adam by email. I've already given you Adam's email address. You can also reach me at eric@supportandresistance.com. All right, so I'll continue to nurse that trade a little bit, and hopefully we can get it up to its profit objective. All right, ladies and gents, if there's no other questions, we're going to wrap things up for today. I'm sorry the markets weren't a little bit more active. Perhaps next week we'll see a little bit more activity. DTS owners, I will see you in the trade room again tomorrow morning, and we'll talk to you then. And of course, we'll have another open house next Wednesday. Have a great day. Bye for now.